Good morning, everybody. It is somewhat of a bloodbath in the global stock markets today, continuing what we saw yesterday in U.S. trading. At some point yesterday, the Dow Jones were down about nearly 6 percentage points, clearly very, very significant falls. And if you've been in the markets over the last year, you basically had concluded that there would never be any volatility. But that is certainly back with a vengeance. VIX spiked, clearly a lot of volatility back in the markets, a lot of uncertainty. Continued overnight in Asia this morning, also very significant sell-off in the stock markets, particularly the Japanese market is selling off quite a bit. Of course, also Japanese stocks have been performing quite well over the last couple of months. So that might be natural, and then continuing this morning, very likely in Europe, we're going to have very significant falls across the board in Europe today. There's no doubt about that. So clearly a lot of blood in the streets. So what have happened? Well, financial genius and economist Fisher Black used to say that financial markets are efficient 90% of the time, and they are 90% efficient. That would mean that essentially nobody would be able to forecast what will happen. It would all be priced in the market, or at least 90% priced in the market. And I believe that this is one of the cases, because we were actually either skilled or lucky over the last couple of weeks to come out with warnings regarding the state of global stock markets. Last week on Friday, I published a piece on Bloomberg Profits, warning that the Goldilocks scenario for stocks was over. Written the same in the Danish Business Daily Børsen on Thursday last week. I've been talking to clients about it over the past week quite extensively. There's no doubt that we had begun to worry that we would have a correction or a sell-off in the global stock markets. And the question is, why did we get it right? What were we looking at? Well, to us, there were two indicators that told us now it was time to take off some risk from the table. What was it? First of all, valuations. Obviously, if you just look at the PE ratios, the US stock market has these very, very high levels, extremely expensive, just judging from PE levels. However, I don't think we can just look at PE levels. We have to compare that with the risk-free interest rates. And they have declined, and I believe structurally quite significantly. So if you correct for that and look at some kind of what somebody calls a Fed model, U.S. equities have actually been cheap since the 2008-9 sell-off and the crisis began there. Since then, we've essentially been in a recovery that took away that cheapness in the market. And for the last 2 years, we have been trading on levels which we consider to be moderately cheap, but close to fair values. But over the past months, we crossed that line. And our indicator for U.S. stocks over the past couple of weeks have been flashing the now U.S. stock market had indeed become overvalued, even taking interest rates into account. So that was the first thing that started to worry us. The second thing is that the very significant sell-off in the dollar recently pushed our indicator for U.S. monetary conditions sharply up across zero, and actually indicating that as a consequence of that, as you remember, our monetary indicator is calibrated such that if it's above zero, it's likely that the Federal Reserve will overshoot its 2% inflation target in the medium term. It's presently at 0.28, meaning that our best forecast for inflation, let's say in 2 to 3 years, would be somewhere in the range of 2.3% inflation. So clearly above the Fed's 2% inflation target, meaning that the Fed would likely have to move more aggressively to control inflation than presently being priced by the markets. So these two factors, the outlook for tighter monetary conditions, also more tightening than previously expected by the markets, and slightly overvalued stock market, in our view, was what was flashing the warning signals 1-2 weeks ago, and what made us make the call on Friday that you should indeed be careful. And of course, I think I never made a forecast or anything where I had the kind of timing of this. I have to admit that there's a lot of luck in these things. But nonetheless, I think that the model framework behind this was proven right. And then therefore, when you look at where we're going from here, I would continue to look at that framework. And so let's start with the valuation. Well, based on that, we are getting closer to fair value once again. CEO valuation is disappearing as stock markets now. The S&P is now down around 8% from the peak last week. So we're taking some of the overvaluation away, but it's probably not entirely gone. More concerning, I would say, is the fact that that monetary conditions have become too easy and remain too easy. Of course, we have seen over the last couple of days the dollar rebound, and I would actually expect some more strength of the dollar in the near future, and that would reduce inflationary pressures. But the question is, would that be enough to keep inflation contained? So what is interesting here is that if you go back to 2009, after the recovery started, we have a couple of incidents where we have seen setbacks in the US stock markets, where the stock market sold off 10-15%. The latest round of this we saw in late 2015, early 2016, where we had a couple of turndowns, and that was very much driven by the fact that the Federal Reserve got ahead of the curve, signaled monetary policy tightening that really wasn't warranted at the time and got too much ahead of the curve. Stock prices were not at the same kind of elevated levels that they have been recently. So the Fed could back off relatively fast, and they did that in January, February of 2016, and then the market started to recover again. The Fed can, of course, do the same thing now. It can come out and say, well, we're not going to hike as aggressively if this financial market turmoil dampens economic growth, reduce inflationary pressures, and we can already see that inflation expectations are coming down. And of course, we have already over the last 2 days seen rate hikes being priced out again, and the question is whether we'll see more of that. So yes, the Fed can step back, be less aggressive, but the problem is that we are not in the same situation as we were in 2016. You know, the Phillips curve focused central bank would look and say, well, the labor market condition is much tighter today than they were in 2015. I personally don't care too much about that, but I do care about monetary indicators, nominal GDP growth, money supply growth, inflation expectations, the dollar. All that indicates that we are at more elevated levels in terms of our monetary conditions indicator than we have been at basically any time since 2008. And therefore, the Fed has less room to step back, less room to accommodate the effect of a drop in the stock market on the economy. Will this therefore turn into a major crisis? Not necessarily, because I'm very positively surprised of the communication from the Federal Reserve over the last couple of months, talking about what should it do if interest rates were to hit the zero lower bound, maybe switch to price level targeting or nominal GDP targeting, at least temporarily. So I do think that the Fed is much better prepared for a bigger sell-off in the market than was the case in 2008. It's better able to handle how to operate monetary policy at the zero lower bound. And remember here, we are still in a situation where it can postpone the shrinking of its balance sheet. It can cut rates, but to begin with, it could signal that it costs less than needed. Therefore, it has plenty of room to ease monetary conditions if needed, and I believe that Jerome Powell will do so. However, he is untested, and he wants to show that he is truly independent. If they get any voices from the Trump administration that the Fed need to act and support the stock market, then he might, of course, feel a need to show the Fed's independence. But for now, I think that actually the Fed has the possibility and likely also the skills to avoid a major meltdown. However, I do see this stock market correction continuing for some time. If you look at the stock market corrections we've gotten since 2009, we have had 2-3 of them in the US stock market. And if we compare to those, we only half through this correction. And remember, at this point, we're actually more elevated on valuations, and the need for tightening monetary conditions is bigger than at any time since 2008. So therefore, the risk is actually that the correction could be bigger than what we got in 16 or 15 and 16, or even back in 2010-11. But I'm not seeing a major meltdown. But the uncertainty could continue for the rest of the month or into the next month, and we could see another 8 or 10% correction in the U.S. stock market. I strongly believe that how that plays out from there on depends on how the Fed comes out now and communicate regarding actions, how it could ease monetary conditions if that becomes necessary. It has already opened the door for that with the comments in its FOMC minutes, and therefore I think that reiterating that would clearly help the market. I don't think that they have to come out now panicking and screaming that they will do all kinds of measures, but they might, when they have the opportunity, come out and say, well, we are keeping a close eyes on this. We are watching inflation expectation. We are certainly also watching the dollar. We wouldn't like to see what happened in 2008, where the dollar appreciated very dramatically on risk aversion. If they can do that, then this will stop. But I would not be long stocks at this stage. I would like to see a little bit more of a correction, so we get out of the overvaluation territory, meaning probably 5 or 8% further down, and then I would see some positive momentum re-emerging in the markets, and I would see a Federal Reserve communicate in a way where I feel that they know what to do if this were to escalate into, for example, a real spike in the dollar. Or very significant financial distress. To me, we are still in very early days of this. This can go all ways. But again, I would say what I said last week. I would take some risk off the table. Obviously, that goes for the stock market, but it also goes for example, emerging markets that seems vulnerable to a spike in the dollar, and cryptocurrencies taking a massive beating. Well, Bitcoin has a lot further down to go. If the dollar continues to strengthen and this uncertainty persists, then I think we could easily hit down towards below 5,000 on Bitcoin. Yeah, for now we keep a bearish take on the market, but I will not scream meltdown. I don't think that we are in a situation like 2008. I think the Fed hopefully learned the lesson and have the instruments to avoid that. So hopefully that's the case. Be safe out there, and remember, spring is coming soon. Thank you.